I want to start, Ray, you have a book, Principles for Dealing with a Changing World Order, in which you take a very broad historical view of, or a very broad view of history and look at cycles and think about, and study them and think about how the world is evolving and has evolved. And if I can sort of summarize it a little bit, it's, you're looking at the cycles and then you're looking at the present moment and you're seeing where we are in those cycles, and it doesn't look so good. Is that it in a nutshell?
In a nutshell, I'll embellish on it a little bit.
Please embellish.
Like, I'm a very practical market guy who's got a global macro investor who's got to place bets. And in my life, there have been a number of times where things came along that I never saw before, and they surprised me, cost me money. And then I realized that when I studied history, that they happened many times in history, repeatedly. So there were three things that are happening now in our lifetimes that never happened before, and that led me to do this study, and then I found that there are 5 big influences. Okay, the three things is the amount of debt and money creation, the monetization of the debt and creations of huge amount of debts. And I wanted to study the rises and declines of reserve currencies and all of that. The second is the amount of internal conflict, populism of the left, populism of the right, that is operating as that conflict, almost a threat to our system. Mm-hmm. And number 3 was the great power conflict between particularly China and the United States. So in my whole lifetime, the United States was a more dominant power, and now we have a great power conflict. So I needed to study those 3 things, and then in studying that history, I found out that the fourth force was acts of nature. Droughts, floods, and pandemics killed more people and toppled more orders than the first 3, so they're a big issue. And of course, climate is a very big issue, cost-wise, what it means. And number 5, of course, is man's evolution in their understanding, and particularly technology. And so we know that technology is going to be a giant force. So I needed to study the patterns or the histories and the cause-effect relationships. And by studying it over that 500 years, it helped me a lot, which, by the way, is not just in the book, but also I did a video that I think is about 40 minutes called The Changing World Order. And if you want to see the video, you can get it in a nutshell.
So help us understand how you think about taking 5 very, very broad observations, trends, things that you see from history. How do you take that and turn that into investable actions, or even forget about investing, or take investing, but then also take how you live your life, how you think about your aspirations, how you think about where you want your life to go, where you want your children's life to go. How do you take those big things and turn them into daily decisions, daily actions?
The first thing I need to do is convert it into data so that I can objectively see things. So you'll see in the book, for example, there's relative education levels, relative 18 measures that go back over the 500-year period so that you can see the cause-effect relationships. I then take those and convert those into indicators. And then that then helps me in my decision rules. I call those principles. But in other words, if this, and this is happening. So for example, I wrote the book about 3 years ago, and there's an arc there about the cause-effect relationships. And since then, there's the January 6th, there's the internal political conflicts, there are these conflicts, blossoming. And I understand them better because I know how to measure them and use them as indicators, such as economic warfare precedes military warfare. Doesn't mean anything is predestined, but when you can understand it like the progression of a disease or something, it's important. And I think that a lot of people make the mistake of seeing everything up close. And so they don't see a lot of the big things that are happening. They're focusing on today's news, today's developments, and then they don't have that arc. But there is an arc. Since over the last 3 years, it's sort of playing out in the direction of that arc. So I understand it better, I use the indicators, and then I make the decision.
So you see the arc, and we can, I think, if I'm not over-interpreting the arc, as sort of in this side of the arc, not this side of the arc.
Well, I guess...
What
yes,
comes
so
next?
let me, I'll describe a little bit the arc, if you want. Okay. There's there's a world order and there's a domestic order. And so at the beginning, this world order began in 1945, the end of World War II. There's usually a civil war or an external war that changes who wins, who loses, and how the system works. Then a new system, a new order comes into power. And then at that time, then there's a rebuilding, and also nobody wants to go back to war, and there's a dominant power, because whoever won, nobody wants to fight the war. And because there's a restructuring of everything, it begins anew. That you eliminate the debts. You do that cleansing, and then you rebuild. And that's a period of prosperity and so on, and it goes on. And people extrapolate that prosperity, they become comfortable with it. But the issue is then, as they do that, they tend to acquire more debt for a variety of reasons. And also, when the country becomes the world's reserve currency, other countries want to save in that currency, and that creates more debt and more. And then also, by its very nature, capitalism creates very big income and wealth gaps. So as it emerges, you have these larger and larger wealth gaps, and you also have larger values gaps. So, and that happens domestically. Internationally, the same sort of thing happens in that countries rise. In other words, the gap in the control doesn't any longer remain dominant. So there's competitors and countries and so on, and they rise. And we don't have a legal system that resolves those disputes. So because of that, then you come into a period of greater conflict and later. So you have the elements that I talked about in the beginning, the debt element, the capitalism element, the splitting and between the various interests and also the wealth and the values differences. And then you have the great power conflict. Now, how that's produced, what transpires is that after such a long time after wars, the new generation never experienced war, and then there is an inclination to have conflict. Because, and let's say today, I think we're in the environment that we see that you have to pick a side and choose. And then there's a conflict on that side. The idea of compromise sounds weak. It's one of those things, compromising what's essential to me? I can't do that. And that creates then threats in the system.
And you're describing the current, that's how you see the current moment. That's where you see us right now in the world.
Right. There are irreconcilable differences. We're now talking about the political part of that, right? Number two is what I'm referring to.
But also number one, the increasing debt loads, the great power conflicts. So all of those things are kind of on the...
They all relate to each other, right? So you have the increasing debt, and then the question is, can you cut spending, or do you monetize the debt? And okay, so think about how we're going to deal with the debt issue in the future and the political parts of that. And that has an influence of who pays, or are you going to monetize the debt?
I can't believe that. I mean, I'm a journalist, so I'm a professional skeptic, but can I take the optimistic side for a moment? And there have been a lot of predictions that the U.S. would decline and the U.S. would lose its reserve currency status and the euro would take over and China would become the world's largest economy and the U.S. was on a sort of inexorable decline, and none of that has happened.
I'm just describing what is and the cause-effect relationships. What we do now determines what will happen.
So you don't think it's baked into a cycle of history that inevitably we're going to have some crash or some big...
No, I think that it all comes down to how people deal with each other.
Okay.
It all comes down. We have more resources than we've ever had in the world. We have more of almost anything that we have. And how we deal with each other, whether we're going to fight about those things or whether we're going to deal smart. The issue is in this dynamic is that the polarity becomes so great that the decision-making becomes so bad that it makes it difficult. And then in addition, there are the realities that have to be dealt with, such as, okay, it's not the same when you have a lot of debt, and that you have to get into a lot of more debt in order to have your spending than if those circumstances weren't the same. So when I look at countries, I look at, basically what I would look as individuals. Do they earn more than they spend? Are they operating well together? And are they at risk of a war? And so I think that those are going to be the drivers of what happens in the future. I think we're going to see it in the elections and so on. I think that but it's not just those, it's the five. So like, for example, if we're dealing with, let's say, the climate issue. The climate issue estimated cost of that is $8 trillion a year. That's monetary part of that. $8 trillion a year is equivalent to 8% of world GDP. I mean, that's very expensive. So there's an economic component, an environmental component. And then, of course, technology is going to have a giant effect. We know we're talking about AI and so on. So we can see that the interrelationships between those are going to be important. So basically what I do is there's a cycle. Think of it like if there's a disease. I use cancer as an example. There's stage 1, there's stage 2, 3, 4, and so on. You could see what the stages are by the symptoms, and you can know how it ordinarily progresses. So you have to know those kind of cause-effect relationships. Those stages are laid out in the book. There's 6 stages of a typical cycle. So all I'm doing is I'm following how is it going according to those stages, what are the cause-effect relationships, and I'm understanding it better, and it helps me bet, which was the same as in the 30s. My studying the 30s allowed me to make the good decisions in 2008 because I understood the dynamic.
I want to zoom in on helps you understand how to bet and really zoom way in from the big to the very small. So maybe we could ground this with a very basic, straightforward markets question, which is everybody has been thinking about interest rates. The consensus thinking about interest rates has changed massively over the last year. What do you think will happen with interest rates by the end of this year? Are we going to see any cuts, no cuts, hikes? What is your take on?
I'm going to answer your question, but I'm going to preface it with what are the determinants that make that.
I'm trying to see how you get from cycles
I'll tell you, yeah.
action.
So for example, when I look at the bond interest rates, you have to have interest rates high enough that it satisfies the creditor without having them so high that it hurts the debtor too badly. And so we look at the real interest rate to be a measure of that. So as you look at the sort of the core inflation rate, whether you say it's 2.5, 3, 3.5, in that vicinity, let's for simplicity call it 3. And then what you do is on a real rate basis, you need 2.5 under normal conditions. So that brings you up to the vicinity of 5-ish, give or take a little bit in terms of the bonds, let's say. And then you ease monetary policy when you have a crisis and you have an unemployment. So you have a situation where, do we have a crisis? No, you have the stock market making new highs, you have the unemployment rate at low levels, and you have a chronically high inflation rate relative to the target. So no, under those circumstances, no, I don't think interest rates should come down, and I think it becomes a bad deal if they come down. In addition to that, you have a supply-demand issue that's important. Under normal circumstances, what I just described determines the pricing. But what you also have a supply-demand. So we're going to have to sell a lot of bonds, because if the government makes a lot of debt, you've got to sell a lot of bonds. There's issues in terms of supply-demand issues for those bonds. I won't get into, but foreign buyers of those bonds, other people in terms of those bonds. So I would say that if I'm looking at the bond rate or if I'm looking at interest rates, I don't like bonds. And I think that the risks are more on the upside of rates than they are on the downside of rates.
How do you, one thing that interests me is that a lot of the kind of conventional ways of thinking about markets have kind of been jostled in the last several years, and one that's prominent right now is gold. So, real interest rates have been rising, gold is rising. What's up with that?
We have a huge amount of debt, and we're creating a huge amount of debt, and most likely there's going to be a monetization of debt. Because if you look at history, when it all comes down to how do you deal with the debt, if you pay it back in hard money, that's a deflationary contraction, and there's usually the monetization. If you take what's going on with Japan now example is a very classic example. What they've done is the Bank of Japan has bought a huge amount of bonds, okay? And all central banks who have bought these bonds have big losses in these bonds. Okay, now there's a dynamic that's underway of they need to have interest rates at a higher level. Why shouldn't their real interest rates be comparable to our real interest rates? If that happens, then they're going to have losses, in addition to others having losses. And when that happens, it makes the bonds less attractive unless you get to that attractive real rate with, let's say, if they go from a minus 1% to a plus 2% or a 3% change in real interest rates, it's a devastating thing. So when we look at Japan or we look at other countries right now, we have that dynamic going on. It's a dynamic, by the way, that we're not used to seeing, but has happened repeatedly in history. And then if you take the question of what is money, and you look at issues of conflict, wars, who can trust what in money? In this environment of great conflict, historically in wars, each country does not want to even lend to the other country because they're worried that if they're lending it, they're going to be paid back in devalued money. And that political element, they don't accept even each other's money. We're going into that pattern that we may not accept each other's money in different ways. So what becomes an alternative money? So you could think of gold as almost being the mirror image of the value of those bonds, in a sense, as an alternative investment. It was the core of what money is until, and in the cycle, we have the evolution of the cycle, 1971 it changes, but you're now, the question is, what kind of money do you have? And so it's a safe haven kind of money. It's the third largest reserve currency of central banks.
And getting bigger.
And getting bigger.
And so in that sense, gold is sort of I'm losing the numbering of your topics, but gold is sort of like a hedge against number 3 again. It's a great conflict hedge again, as opposed to a.
And it's both conflict and also value of money. So if you have a lot of debt, you're going to have to pay it, and you'll have a choice. You'll pay it in hard money, or you're going to pay it in soft money. And when the central banks get into that position, they play it in soft money. So when you look at the prospective situation of just the debt money question, and then you overlay that on top of the political situation question, it's a favorable investment, and it's not a hot investment in terms of sentiment and so on. You know, there's not much talk about gold, which also is a good sign in terms of that. Now, I'm not saying that people. Let me be clear. I'm not saying people should run out and get a lot of gold, and I don't
get it at Costco.
I don't want to get. Can you?
You can. Yes, you can.
Wow, isn't that interesting?
There you go.
But I am saying that for the reasons I'm describing, it is a diversifier against the other aspects of the portfolio. If you were to do a portfolio optimization of saying how much would you have in that because of the diversification benefits and so on, under normal circumstances without having a view of gold, you would have almost 15% in the portfolio. I'm not saying it should be that number. I'm not saying that. But if you look at it, I think people are long money in debt, and they're short gold as a percentage of their portfolio, and the dynamic is changing. It's making new highs. So I think it has to be a part, a relatively small part, but it has to be a part of something.
Can I ask you to continuing on that theme? This is we're at the Future of Everything conference. Many of the people in the audience here are starting out in their careers and getting going, and I was wondering what advice you would have for them if they had $10,000. What would you, not Ray Dalio, you after a 5-decade career and having made lots and lots and lots more than $10,000, what would you, sort of Ray Dalio 5 decades ago, in the present, suggest to people here with $10,000?
Well, yes, so I would say the first thing that you have to do is think about the purpose of money, and that you're saving and immunizing yourself against the purpose of money and what is most valuable of that. Almost if you were to think, Can I buy, maybe it's buy my apartment or secure my future. If I could pre-buy my kids' education, if I could pre-buy those types of things so that I can immunize myself, I can hedge myself, that I'm going to be good and I'm going to be stable. I know when I started working out, I was when I was in the position you're describing, I said to myself, how many weeks, months, or years could I live without our money coming in? If I should be dropped and I lose my job or something, how do I establish that security to basically immunize those types of things? So I think that starting out with thinking about the purpose of the money and how you immunize yourself against those things is very, very important. Then when you go to higher levels, then you decide how you're going to take risks relative to that. So I would say, but I'd say if I was to say one headline, it would be first, immunize yourself against those things. Then secondly, think about your returns in real returns, and most importantly, how you diversify well. The power of diversification, the holy grail of investing when I discovered it, it meant everything to me, was can I find, optimally, 15 good, uncorrelated return streams? Because the power of diversification, good diversification means that you can reduce your risks by 80% without reducing your expected returns. And that means you improve your risk-return ratio by a factor of 5. And if you can understand how to diversify well, immunize your liabilities, I think that's the approach that I would take.
I'd like to take some questions from the audience. So if you have a question, please pop your hand up. I'm going to ask Ray one more thing, but then we'll come to questions in the audience. So sticking with that again, how would you think about that question? The answer that you gave is something that I think has been universally true for quite a number of years. Diversified investments have been something that lots of people have had at the core of thinking about portfolio theory for a long, long time. You're describing this new changing world order. Things are shifting. The world that will be around in 40 years for people in this room is not going to look like what the world was 40 years ago. Does your advice change, or is it still the same despite the cycles of the
It means it more so. It means the uncertainties are going to be great. Think about the implications, let's say, AI is going to have on companies, who the winners and the losers are. Like, we have a lot more uncertainty about who the winners and losers are.
Yep.
If I take any one of these factors, what it does is it creates much more uncertainties. And so it makes diversification. And then you think about diversification of asset classes, diversification of countries where you're diversified in. All of that diversification is going to matter, I think, more, not less.
There was a question in the back there I saw, but if that person's lost his hand, how about right here in the front?
Well, the question is,
Mike behind you, there you go.
things seem to be increasingly correlated, and it's harder.
I'm sorry, I didn't hear you.
Things seem to be increasingly correlated, so it's harder to find real diversification. Can you mention some assets that are really uncorrelated these days?
So first of all, correlation is an outcome of the determinants of the pricing. Correlation doesn't intrinsically exist. And if you look at the pricing of asset classes, it makes sense. So for example, stocks will go up when growth is faster than discounted, and it'll go down if it's less. Bonds are the opposite sort of way, generally speaking. So the way I think of diversification is that there are four main quadrants in that. That means inflation rises or declines, or growth rises and declines. And if by looking at those and putting those into those four quadrants, I'm trying to then create that's the template. How diversification changes through time is a function of those drivers. And so when I create the diversification, those are the drivers I look at. Of course, the tightness of money and the looseness of money raises or lowers all boats or all investments. So if you look at the structure of the determination of the correlations, and so you have that structural diversification, not just looking at what the recent correlations are, because correlations change over time. So, but the determinants of those correlations don't change, or they change very little. Because every asset is, every investment is a lump sum payment for a future cash flow. It's true of all investments. So when you're looking at it and you say, I'm going to make a lump sum payment, what are the determinants of those future cash flows? Okay, the determinants are those factors I just mentioned.